Welcome back to Building Wealth Today TV. Today, we're diving into a crucial topic that affects millions of people. How to improve your credit score, even if you've had late payments, collections, or filed for bankruptcy. Your credit score is like your financial GPA. It tells lenders how risky you are to lend money to. A higher score means you're more likely to get approved for loans and credit cards with lower interest rates. And trust me, those interest rates can add up big time. We're talking about thousands, even tens of thousands of dollars in savings over the life of a loan, just by having a good credit score. Whether you're buying a house, a car, or even just trying to rent an apartment, a good credit score is absolutely essential. So, if you're ready to unlock better financial opportunities and save yourself a ton of money in the long run, stick around because I'm breaking down 10 powerful steps to boost your credit score. Let's get started. The first step to improving your credit score is knowing where you stand. You can't fix what you don't know is broken, right? That's why it's crucial to check your credit report regularly. Think of it like checking your bank account. You wouldn't wait months to see if there are any errors or fraudulent activity, would you? Your credit report is the same idea. You want to make sure everything is accurate and up to date. The good news is you can get a free credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, once a year at annualcreditreport.com. That's right, once a year you can get a comprehensive look at your credit history without spending a dime. Take advantage of this free resource and request a report from one bureau every 4 months. This way, you're essentially monitoring your credit throughout the year and catching any potential issues early on. Once you have your credit report in hand, take the time to review it carefully. Look for any inaccuracies, such as incorrect addresses, accounts you don't recognize, or late payments that you know you made on time. Remember, even small errors can drag down your score. Don't just skim through it. Really scrutinize every detail. You're looking for anything that doesn't look right, even if it seems minor. Next, pay close attention to your credit utilization. This refers to the amount of credit you're using compared to your total available credit. Lower utilization is better, and I recommend keeping it below 30% for a healthy credit score. Finally, check for any negative marks like late payments, collections, or bankruptcies. These can stay on your report for several years and significantly impact your score. But don't worry, we'll discuss strategies to address these later on in this video. Now that you know how to check your credit report, let's talk about what to do if you find errors. Disputing inaccuracies is crucial because they can significantly impact your credit score. Remember, your credit score is a major factor in determining your interest rates, loan approvals, and even your ability to rent an apartment. Start by reviewing your report line by line, carefully checking for any inconsistencies. Look for accounts you don't recognize, incorrect balances, or payments marked late that you know you made on time. These are all red flags that need to be addressed immediately. Don't assume that just because something is on your credit report, it's accurate. Credit bureaus aren't perfect, and mistakes happen. You have the right to dispute any inaccurate information, and it's often easier than you think. Remember, your credit score is a reflection of your financial health, so it's essential to ensure that it's an accurate representation. Once you've identified errors on your credit report, it's time to take action and dispute them. Fortunately, the process is relatively straightforward. You can dispute errors online, by mail, or over the phone, depending on your preference and the credit bureau you're dealing with. When disputing an error, be sure to provide specific details about the inaccuracy, including the account name, account number, and the date the error occurred. Include copies of any supporting documentation you have, such as bank statements or payment confirmations. The credit bureau then has 30 days to investigate your dispute and provide you with a response. If they find the information is indeed inaccurate, they are legally obligated to correct it. This can lead to a significant improvement in your credit score. Remember, Disputing errors is your right, and it's a crucial step in maintaining a healthy credit history. Don't hesitate to take action if you find any inaccuracies on your report. All right, let's talk about the big one: paying your bills on time. This single factor accounts for a whopping 35% of your credit score. So if you're serious about building credit, this is non-negotiable. Think of it like this. Every time you make a payment on time, you're basically telling lenders, hey, I'm responsible, I can handle my finances, and you can trust me to pay back what I owe. On the flip side, late payments can really ding your score, especially if they're frequent or severely delinquent. We're talking 30, 60, 90 days late. These negative marks stay on your report for 7 years, potentially scaring off lenders and making it harder to qualify for loans, apartments, even jobs in some cases. So, how do you make sure you never miss a payment? Well, for starters, set up automatic payments for all your recurring bills. Most banks and credit card companies offer this feature, and it's a lifesaver when it comes to avoiding those accidental late fees. But don't just rely on autopay and forget about it. It's crucial to regularly review your account statements to catch any errors or unauthorized charges. You don't want to be caught off guard by a surprise expense that drains your account and results in a missed payment. Now, I get it. Life happens. Sometimes unexpected expenses pop up, or you might experience a temporary financial setback. If you're struggling to make a payment, don't bury your head in the sand. The worst thing you can do is ignore the problem. Instead, reach out to your creditors as soon as possible. Explain your situation and see if you can work out a payment plan or temporary hardship program. Remember, communication is key. Most creditors are willing to work with you if you're upfront and proactive about finding a solution. They'd rather get something than nothing, right? Another tip is to build a solid budget and stick to it. Track your income and expenses, identify areas where you can cut back, and allocate funds specifically for your bills. Having a clear picture of your finances will help you stay organized, avoid overspending, and ensure you have enough to cover your obligations. And finally, don't be afraid to ask for help if you need it. There are resources available, such as credit counseling agencies, that can provide guidance and support in managing your finances and improving your credit score. Let's move on to another crucial factor that impacts your creditworthiness: your debt-to-income ratio, or DTI for short. This basically compares how much money you owe each month to how much you earn. Lenders use this ratio to assess your ability to repay borrowed money. A high DTI indicates that a large portion of your income is going towards debt payments, which can be a red flag for lenders. It suggests you might have less financial flexibility and a higher risk of defaulting on your loans. Ideally, you want to aim for a DTI of 36% or lower. This is the sweet spot that most lenders consider to be a healthy and manageable level of debt. But how do you calculate your DTI? It's actually pretty simple. First, add up all your monthly debt payments, including things like credit card bills, student loans, car payments, and personal loans. Then, divide that number by your gross monthly income, which is your income before taxes and other deductions. The resulting percentage is your DTI. Now, if you're looking at your DTI and realizing it's higher than you'd like, don't panic. There are several strategies you can implement to bring it down. One obvious approach is to focus on paying down your existing debt. Create a debt repayment plan, prioritize high-interest debt, and consider strategies like the debt snowball or avalanche method. Every dollar you put towards paying down your principal balance lowers your overall debt and improves your DTI. Another effective strategy is to increase your income. This could involve negotiating a raise at your current job, taking on a side hustle, or exploring new career opportunities. Remember, every extra dollar you earn gives you more breathing room in your budget and helps you chip away at your debt faster. And while it might go without saying, it's crucial to avoid taking on new debt while you're trying to improve your DTI. Before applying for any new credit cards or loans, carefully consider whether it's absolutely necessary and how it will impact your debt-to-income ratio. All right, let's talk about something that might seem counterintuitive at first: keeping old credit accounts open. You might be tempted to close those old credit cards you never use anymore, but trust me, it's generally in your best interest to keep them open. Why? Well, the length of your credit history plays a significant role in determining your credit score. It accounts for about 15% of your FICO score, which is the credit scoring model used by most lenders. Think of it like this: the longer you've been responsibly managing credit, the more confidence lenders have in your ability to handle it in the future. A long and positive credit history demonstrates stability and financial responsibility. Closing old accounts, especially if they're among your oldest, can actually shorten your credit history and potentially lower your score. This is because your credit report considers the average age of all your accounts, both open and closed. Now, I understand that keeping track of multiple credit cards can be a bit of a hassle. You might be worried about annual fees or the temptation to overspend, but there are ways to manage old accounts without negatively impacting your credit. First, make sure you're not paying any unnecessary fees. Some credit cards come with annual fees, but many don't. If you have an old card with an annual fee that you're not using, consider calling the issuer and asking if they can waive the fee or downgrade you to a no annual fee card. To avoid the temptation to overspend, you can simply store the card away safely and only use it for a small recurring purchase, like a streaming subscription or a monthly bill. This keeps the account active without adding unnecessary debt. Another option is to set up a small recurring payment, like $5 or $10, to be automatically charged to the card each month and then automatically paid off in full. This demonstrates responsible credit utilization and helps maintain a positive payment history. Remember, when it comes to credit, longevity matters. Keeping those old accounts open can give your score a nice boost and portray you as a responsible borrower in the eyes of lenders. All right, let's say you're starting with little to no credit history. It's tough to get approved for a traditional credit card, right? That's where secured credit cards come in clutch. These are like the training wheels of the credit world. With a secured card, you put down a security deposit, which typically becomes your credit limit. So if you put down $500, you've got a $500 credit limit. Don't worry, you're not actually spending that deposit. It acts as collateral for the lender in case you miss payments. The beauty of secured cards is they're much easier to get approved for than unsecured cards. You use it just like a regular credit card. Buy groceries, pay for gas. And as long as you're making on-time payments, you're building that positive credit history. Think of it as proving to lenders that you can handle credit responsibly. After 6 to 12 months of responsible use, you might even be able to upgrade to a regular unsecured card and get your security deposit back. Now, when you're shopping for a secured card, pay close attention to the fees. Some cards charge annual fees, while others might have monthly maintenance fees. Do your research, compare options, and find one that fits your budget. And listen, just because you have a credit limit doesn't mean you should max it out every month. Ideally, try to keep your credit utilization below 30%. So, on a $500 limit, aim to keep your balance below $150. Remember, the goal here is to build positive credit, not bury yourself in debt. Set up automatic payments so you never miss a due date, and keep track of your spending. These small steps can make a huge difference in boosting your credit score over time. And trust me, a good credit score is like having a golden ticket. It unlocks better interest rates on loans, better chances of getting approved for apartments, and can even save you money on car insurance. It's worth putting in the effort now to reap the benefits later. Having a diverse credit mix is like having a well-balanced investment portfolio. It shows lenders you can handle different types of credit responsibly. Think about it. If you've only ever had one type of credit, like a credit card, lenders don't have a complete picture of your financial habits. But if you have a mix of credit, maybe a credit card, a student loan, or even a car loan, it demonstrates a broader history of managing debt. It tells lenders you're not a one-trick pony and can handle different types of financial responsibility. Now, I'm not saying go out and get into debt just to diversify your credit. That's the last thing you want to do. But if you're considering a loan for a responsible purchase, like a car or a house, it could actually benefit your credit score in the long run. Just remember, responsible borrowing is key. Make sure you can comfortably afford the monthly payments before taking on any new debt. The last thing you want is to overextend yourself and hurt your credit score in the process. Building a diverse credit mix takes time. It's not something you can achieve overnight. Start by focusing on the types of credit you already have and manage them responsibly. If you have a credit card, use it for small purchases and pay it off in full each month. If you have student loans, make consistent on-time payments. And if you're thinking about getting a car loan, shop around for the best interest rates and make sure you can comfortably afford the monthly payments. Remember, every positive action you take, like making on-time payments and keeping your balances low, contributes to a healthier credit mix over time. And a healthy credit mix translates to a higher credit score, which opens doors to better financial opportunities down the road. It's all about playing the long game here. Don't expect to see drastic changes overnight. But by being patient, consistent, and responsible with your credit, you'll steadily build a strong credit profile that will benefit you for years to come. All right, becoming an authorized user on someone else's credit card can be a fantastic way to boost your credit score, especially if you're starting with limited or no credit history. Essentially, it's like getting a shortcut to a better credit score. When you're added as an authorized user, the account's history gets factored into your credit report, even if you don't personally use the card. This means you benefit from the primary cardholder's positive payment history, lower credit utilization, and longer credit history. Now, it's crucial to choose the right person to become an authorized user on their account. Ideally, you want someone with a long history of on-time payments, low credit utilization, and a good credit score. Their good credit habits will reflect positively on your credit report. However, a word of caution: if the primary cardholder has a history of late payments or high balances, it can actually hurt your credit score. So choose wisely and make sure you trust the person you're linking your credit to. Becoming an authorized user can be a win-win situation for both parties involved. For the authorized user, it's an opportunity to build credit without having to apply for their own card. And for the primary cardholder, it can be a way to help a friend or family member improve their credit. However, it's essential to establish clear communication and expectations from the beginning. Discuss whether the authorized user will have access to the card and, if so, set spending limits and repayment agreements. Remember, even though you're not the primary cardholder, the account's activity will be reflected on your credit report. So, it's crucial to use the card responsibly and make payments on time if you have access to it. Becoming an authorized user is a great tool to boost your credit, but it's not a magic solution. It's essential to use it wisely, communicate openly with the primary cardholder, and continue practicing good credit habits to build a strong credit history. All right, so we're on step number 9, limiting those hard inquiries. Now, you've probably heard this term thrown around, but what does it actually mean? Essentially, a hard inquiry happens when a lender checks your credit report because you've applied for credit. Think of it like someone peeking into your financial history when you're asking to borrow money. Now, a single hard inquiry might not seem like a big deal, and honestly, it usually isn't. It might only drop your score by a few points. But here's the thing, multiple hard inquiries in a short period, say within 6 months to a year, can really start to add up and drag down your score. Why? Because it signals to lenders that you might be desperate for credit, which can make them a little bit hesitant to lend to you. Imagine walking into 5 different banks in a day, asking for a loan. They might start to wonder what's going on. So, how do you keep these hard inquiries to a minimum? Well, first off, don't go on a credit card application spree. Be strategic about when you apply for new credit. If you're shopping around for a car loan or a mortgage or student loan, try to do it within a short time frame, like a couple of weeks. This may count as a single inquiry to minimize credit score impact. This way, multiple inquiries from different lenders will typically be grouped together as one inquiry on your credit report, minimizing the impact on your score. Remember, a little bit of planning and understanding can go a long way in protecting that credit score of yours. Now, there are also some sneaky hard inquiries that you might not even realize are happening. For example, did you know that even just checking your own credit card offers online can sometimes trigger a hard inquiry? That's why it's crucial to read the fine print and understand what you're agreeing to before you click that button. Another thing to watch out for is pre-approved credit card offers that come in the mail. I know, it's tempting to jump on those, especially if they promise amazing rewards or a low introductory rate. But be aware that responding to these offers and going through the application process will often result in a hard inquiry, even if you end up not accepting the offer. The good news is that not all credit checks are considered hard inquiries. When you're simply checking your own credit report, maybe through Credit Karma or annualcreditreport.com, that's considered a soft inquiry. And the best part is, soft inquiries don't affect your credit score at all. So the key takeaway here is to be mindful of when and why your credit is being checked. Avoid unnecessary hard inquiries whenever possible, and always prioritize those soft inquiries when you just want to keep an eye on your credit health. Rebuilding your credit after filing for bankruptcy can feel like an uphill battle, but it's absolutely possible with the right strategies and a bit of patience. First, it's important to remember that bankruptcy doesn't mean the end of your financial journey. Rather, it's a fresh start. Begin by understanding your current credit situation. Obtain a copy of your credit report to see what debts have been discharged and ensure there are no errors. Next, focus on creating a budget that prioritizes essential expenses and helps you avoid falling back into debt. One of the most effective ways to rebuild your credit is by using a secured credit card. These cards require a security deposit, which acts as your credit limit. Use the card responsibly by making small purchases and paying off the balance in full each month. Over time, this will demonstrate your ability to manage credit responsibly. Additionally, consider becoming an authorized user on a family member's or friend's credit card. This can help you benefit from their positive credit history, provided they have a good credit score and responsible payment habits. Another key strategy is to take out a credit builder loan, which is specifically designed to help improve credit scores. These loans are typically small and require you to make regular payments, which are reported to the credit bureaus. Lastly, practice patience and consistency. Rebuilding credit takes time, but by making timely payments, keeping your credit utilization low, and monitoring your progress, you'll start to see improvements in your credit score. Remember, bankruptcy is not the end, but a new beginning. With dedication and smart financial habits, you can rebuild your credit and achieve a brighter financial future. All right, let's talk about the 10th and final step to boosting your credit score, setting up payment reminders. I know, it sounds super basic, but trust me, this is one of the easiest yet most effective things you can do to improve your credit worthiness. Remember, payment history makes up a whopping 35% of your FICO score, the most widely used credit scoring model. That means even one late payment can send your score tumbling down, and that can have some serious consequences. A lower credit score can mean higher interest rates on loans, difficulty renting an apartment, or even getting denied for a job. No one wants to deal with that kind of financial headache. So, how do you make sure you never miss a payment deadline? That's where payment reminders come in. Think of them like your personal credit score superheroes, swooping in to save the day and keep your finances on track. The beauty of payment reminders is that they're incredibly easy to set up, and there are tons of options to fit your lifestyle. You can use the old school method of writing it down in a planner or sticking a sticky note on your fridge. Or, if you're more digitally inclined, take advantage of the technology at your fingertips. Most banks and credit card companies offer free email or text message alerts that remind you when a payment is due. You can customize these alerts to your liking, choosing the frequency and delivery method that works best for you. No more excuses about forgetting. And if you're really serious about staying on top of your finances, consider using a budgeting app like Mint or Personal Capital. These apps connect to your bank accounts and credit cards, giving you a comprehensive overview of your spending and upcoming bills. They also have built-in payment reminder features that can send you notifications well in advance of your due dates. But here's the thing. Setting up payment reminders is just the first step. You also need to make sure you're actually paying attention to them. It's easy to dismiss a notification or let an email get lost in the shuffle. So make a conscious effort to review your reminders regularly and schedule dedicated time each month to pay your bills. Trust me, your future self will thank you for it. By staying organized and proactive, you'll avoid those costly late fees and keep your credit score healthy and happy. And there you have it, 10 powerful steps to take control of your credit and boost your score. Remember, improving your credit takes time and effort, but the rewards are well worth it. From qualifying for lower interest rates to having more financial freedom, a good credit score can open up a world of opportunities. Thanks for watching. If you found this video helpful, make sure to give it a thumbs up and subscribe for more tips on personal finance and credit improvement. Leave a comment below if you have any questions or topics you'd like us to cover next. See you in the next video.